And it's time for the MF Corner, and this is the time when everyone rushes with last-minute investments to save tax. Let's start with Dhirendra Kumar from Value Research on how much tax can you save by investing in mutual funds, and take some of your queries as well. Dhirendra, everyone wants to invest to save tax. Break down for us how much tax is levied on equity funds and how much can one save by investing into ELSS funds?
No, first you have to really get a sense that under section 80C, if any individual can invest up to 100,000 rupees, 1 lakh rupees, and that is a deductible income for computing taxes. And the eligible investment avenues, there are of all kind. And when you invest in the ELSS funds, all your investment is tax-free, is deductible from, is deducted from income, and not only it's deducted from income, all the gains are tax-free because gains from equity and equity mutual fund is tax-free. So not only you get a tax break when you invest, all your appreciation from the ELSS is tax-free, whereas if you choose to invest in the 5-year fixed deposit or NSC, the income from those investments is not actually tax-free.
Are debt schemes also subjected to tax? Are there any debt mutual funds where investors can save on tax? Would you recommend any of them to investors?
No, there are no debt investment, tax saving fixed income or debt investments, debt mutual fund which is eligible for tax break. The only option is that there are 2 pension plans offered by UTI and Franklin Templeton, and they are hybrid, they are debt oriented hybrid fund. A good part of that money is invested in debt, but it also has 30 to 40% into equity, so there is no pure debt fund which is eligible for investment tax break.
Let's take inquiries then on that note, and our first query is from Rohit Chaudhary. He wants to know FMCG funds have given good returns, but not many analysts recommend them. So he wants to know, should he go in for ICICI or SBI FMCG?
Yes, no analyst normally, and we also at Value Research don't recommend FMCG fund or any sectoral fund for that matter, or any thematic fund for that matter. Because the reason why you invest in a mutual fund is to diversify. And these funds are not a diversified vehicle. These are, vehicle of targeted, they're concentrated funds which invest only in FMCG stocks or, other sector funds focus on different sectors or theme. And so these funds are not suited for most investors. They are suited only for investors who are, and when you invest in a diversified fund, you are getting a FMCG exposure. And when you invest in a sector fund, you are giving a very limited mandate. You are not taking the full advantage of a mutual fund. So one should have these sector funds only when you think that there is something missing in your portfolio and you want to supplement that. And sector funds, because of their concentration, they either do very well or very poorly. And right now FMCG funds, because of the 5-year of upheavals and the decline, and this is one consumption story which has done very nicely, so they have done very well.